Most investors think senior living is one of the safest investments in real estate. But here's the truth. A lot of investors lose money in this space. Not because of the market, not because of the building, because they're analyzing it completely wrong. And what I'm about to show you is exactly why deals that look good on paper quietly fail in the real world. My name is Roberto Carabetta, and this is the SLAM Playbook YouTube channel. SLAM stands for Senior Living and Multifamily Playbook. I acquire and operate senior living facilities. On this channel, I break down how these deals actually work, so the investors like you understand where the real opportunity is. Today, I'm going to show you why most senior living deals fail and how disciplined investors avoid it. Step one, the core mistake people make. Most investors analyze senior living like multifamily, and it is completely different. I actually come from the multifamily investment world, and I still own multifamily properties. Not that it's a bad investment, but it's not a similar investment to investing in senior living. In multifamily, they look at price per unit, cap rates, rent comps. Yeah, that works in multifamily, that works in senior living, but the difference is in senior living, there's more to look at. Senior living is not driven by rent. It's driven by operations and systems. This is not just a real estate investment, it's a business investment. And if the business fails, the investment fails. Why do deals fail? Senior living deals, they don't fail because of location, because of the building. They fail because of the operations. Bad staffing decisions, no systems, weak leadership, no control over their payroll. And this is where most investors get it wrong. In senior living, you have to think of it as different pieces of the puzzle. And when all these pieces come together, you either have a strong business plan or you have weak, broken systems. If one or two pieces of this puzzle are not accurate or not fitting properly together, you have a broken system. Do you want to see a completed puzzle, or do you want to see a puzzle missing one or two pieces? So that's where multifamily and senior living investments differentiate themselves. In senior living, you're investing in a business, not real estate. And when I'm underwriting these senior living deals, I'm not just showing you fancy numbers, fancy returns. I'm educating you and showing you exactly how I got to those returns. It's not about putting a shiny number in front of you. It's about educating and explaining how I got to that number. In senior living, like I said, there's multiple pieces to the puzzle. There's multiple gears moving at the same time, and they all have to be working together. So if I can explain to you what staffing pattern I'm using, what systems I'm implementing, how my leadership team is guiding the ship, and how I'm controlling your largest expense item, which is payroll, if I can show you that and show you how I'm getting to these returns, that means it's a more solid, more educated investment for you, the investor. So we look at high priced line items or high dollar amount line items. And what's the highest expense line item in senior living? It's payroll. Payroll is the largest expense in senior living. It's typically 55%, maybe 60% of total costs. And this is the line item that destroys any deal more than anything else. If you have a bad marketing plan, you can kind of get over it, fix that line item, fix that system, and it won't really move the needle too much on your net operating income, which that drives the value. But if you're taking 50, 55% line item and you're incorrectly using it or evaluating it, it's up 5% or down 5%, that moves your bottom line exponentially. A facility that generates $3 million a year, call it payroll at 60%, that's $1.8 million going towards payroll. So you have to get it right. What if your payroll creeps up to 65%? That's $150,000 in lost net operating income, NOI. At a 7% cap, that's over $2 million in lost value. So one line item can decrease valuation by $2 million or more. But the opposite can happen also. If you're analyzing payroll as a strong operator like myself, and you're looking at what payroll numbers I actually need for my community to operate efficiently, maybe I have too many weak staff members on the floor at the same time, and they're not producing what they're supposed to be. And that can increase my payroll, because maybe I need 2.5 or 3 staff members. Instead of, if I have 2 strong staff members, I might not need that 2.5 or 3 staff member ratio, because they can handle it between the two of them. So that can decrease a couple percentage points my payroll, which in turn increases my value, my valuation. I'm not saying I'm driving my staff members to the ground, but you have good working, dedicated staff members that come to the communities, come show up for their shift and give it all they got. They're committed to themselves and to the company, corporation, so they do their best. But then if you have staff members that show up and don't care, that can increase your payroll, because you have to substitute for their lack of effort they're giving to that community or to that care. So payroll is a huge expense line item that experienced operators and owners keep an eye on every single day. My KPI, key principal indicators, my KPI chart has staffing as my number 1 indicator. And I look at it every 2 days to make sure I'm not losing track of it, to make sure my ratios are in check. Because that's the biggest, largest expense item I have to incorporate in my operations. Let's talk revenue. Yeah, people think revenue. They think this is what drives the business. It's not just revenue. It's not just rent. Revenue is driven by care levels, services, medication management, and even memory care. We can charge other income for more care level if they are assisted living, but they need a little bit of medication management, or they want transportation to their doctor's appointments or grocery store, then we can charge for that. That's other income line item that generates revenue. Multifamily, you just have maybe 2 or 3 other income line items that really impact the growth, the revenue. In assisted living, senior living, memory care, you have a whole bunch of options. If strategically used correctly, can drive that revenue. It's not driven solely by rent. You have to look at other components that generate the revenue inside your business. So let's look at 2 facilities. Same size, same occupancy. One generates $4,200 per resident. The other generates $5,200 per resident. That's about $800,000 annual difference. That's huge. And most investors will pick the business plan that generates $5,200 per resident for the rent. And I'm talking base rent. But what if that $4,200 base rent resident has other additional revenue drivers, other income on top of them? What if they're paying a little bit more for medication management? What if they're paying for transportation, level of care services? that $4,200 per resident number can easily surpass $5,200 per resident. So you can have two same size facilities, same occupancy, but your other rent, your other revenue drivers are higher in the one community. That drives your NOI, net operating income, which increases your valuation. So same real estate, different operations. This is why two investors can look at the same deal and get completely different results. You're not just looking at one number. It's a whole system, a whole business, a whole operation that you have to understand. You have staffing ratios. That comes into effect in your payroll. You have revenue drivers that can increase your income. That's something else you have to look for. And now, what if you have too many high acuity residents? That means you need more staff to pay attention to these residents. Some residents need 2 people to lift out of bed, or 2 people to bathe, or you need 1.5 staff members to help them feed and move around the community. If you have 80% of your residents needing that level of care, yeah, your revenue is higher, but also your expenses, your payroll line item goes through the roof. You're like doubling up payroll just to take care of your residents. And to me, that's not a good business plan. Yeah, you're going to have some residents that have that needed staff attention, but your whole community can't have a high percentage of that. You need a mix. Maybe you have a resident coming in that's paying $4,500 a month, but they don't need too much attention. So they're easy, smooth sailing residents that want a sense of community, a sense of belonging. And our staff doesn't have to have their eyes on them. They don't have to be attentive to them every single minute of the day. So that eases up our payroll cost line item. There's a thing that we call occupancy impact. Let's say the facility has 80 units. At 70% occupancy, that's 56 residents. At $4,700 per resident, that's over $260,000 per month. Now let's move the needle. Let's move the occupancy needle. We're doing a marketing plan, marketing strategy. We're able to get 85% occupancy. Yeah, that's good. That's 68 residents. Now your revenue jumps $300,000 or more per month just by increasing 15% occupancy on an 80 unit building. That's over $650,000 per year hitting your bottom line, increasing your NOI, increasing valuation. We've done no construction, no expansion, no crazy disruption to the business. All we did is implement a strategy, increase occupancy, and drives our NOI and valuation. It's just simple operations. But good operators, good owners understand what metrics are moving the revenue or decreasing the expenses. It's not just a one button clicks that fixes everything. These are serious line items that we all have to take in consideration and have our eyeballs on them every single day. It's all strategizing. What's our marketing plan? What's our marketing dollar? What's our NOI attached to that marketing dollar? We could be spending $200,000 a year on marketing plan, but then what? If it's not driving move-ins, what's the point? Or it's only driving 2 move-ins a month, what's the point? Our ROI, return on investment, is not maximizing our business plan, not maximizing our bottom line net operating income. The operator, oh my God. The operator is the most important, crucial part of all of this that I'm talking about. The whole business plan, the whole investment hinges on the operator, the operations. And this is where investors get it completely wrong. They focus on the property. A lot of investors in this space come from the multifamily investment world. And that's real estate driven, mainly on appreciation. Look at the last 15 years in real estate. Appreciation has only been going up. So yeah, a multifamily deal made money. Of course it made money because the appreciation was idiot proof. Everything went up. A good investment, a bad investment, every real estate property increased in value because of the appreciation. And in turn, it benefits the investors and the syndicators, and we all make money. So everyone's happy. But in today's market, you have to be very wary of investing in multifamily deals because you can't bet on appreciation alone. You have to bet on purchasing dollar. Did they get in the entry? Did they get in at the right dollar amount? And what's their exit strategy? Yeah, you can increase rents by $50. Woohoo! That's not going to move the needle all that much. It will move the needle, but not all that much because your appreciation play isn't there like it was the last 10, 15 years. But senior living, investing in senior living, remember, you're not investing in the real estate alone. You're investing in the business, the operations, the system, the people, the leaders, the operator. The operators control staff, revenue, expenses, occupancy, and execution. You're not buying real estate, you're investing in a business. When you go in the stock market and invest in the stock, are you investing in the stock market to go up or increase altogether? Or are you investing in that business, that company, that corporation? You're going to do your due diligence on that corporation, on its leadership, on its financial history, on its financial pro forma, on the current state of their company's trajectory right now, on their executives' past, present, and future obligations. Same thing with investing in senior living. When you invest alongside me and my partners, you can dig deep into our past, what we're doing presently in our communities, and our future outlook. This is what we anticipate. What's our growth pattern? What's our pro forma, our trajectory? And is it stable enough to hit those numbers? So I educate you before you invest on how I got to these returns. I'm not just throwing a fancy number in front of you and hoping you're going to like it or hoping you're going to invest your hard-earned money in a deal because I threw a fancy number in front of you. No. I'm going to walk you through how I got to that fancy number. What cells in my spreadsheet are changing those returns? Are they realistic? Are they favorable? Are they doable? So if I'm changing payroll and changing marketing and changing staff care, is that really, truly going to change those returns? Or am I increasing occupancy but leaving my payroll the same? Because more occupancy includes more payroll. So each line item has to increase. What do you think today's market that we're in right now? You think payroll is going to decrease over time or increase? I think increase. So whether you have move-ins or not, your payroll is going up. So you have to have a plan to get move-ins on a consistent basis and then escalate your payroll and other line items on the expense side at an appropriate rate. Usually, typically, I like to increase expenses 5% year over year. If this is your first time hearing this, comment SLF below. This is where most investors get it wrong. Education comes first, and I'm here to educate every single investor that listens to this YouTube channel. So comment SLF below if this is your first time hearing this. I've seen deals look great on paper. They have strong occupancy, good pricing, but there's no operational control. There's no systems in place. There's no discipline. And within 12 months, your margins are compressed. Your NOI drops. Your value drops. The building doesn't fail. The business fails. Because remember, I stress this, you're investing in a business. You need the right leadership. You need the right systems. So what is the operator, what is the owner doing to drive this business? Are they just blowing fluff and not educating you on the reality of the business? Are they highlighting what can go right? Are they highlighting what can go wrong? Because things go wrong in business, but it's how we react. Do we have the right systems to notify us for certain changes in our operations? Do we have the right staff that can do the job? Or are we just filling up staff, presenting to you as the investor our staffing payroll chart, but really they're struggling on the floor level? And you guys don't see that. But a trusted, honest, educated, responsible operator, owner will correct those in a meaningful manner and communicate that to you, the investors. So there's a huge opportunity in the senior living industry. Right now, a lot of investors, a lot of syndicators, a lot of private equity money, they're moving into this space. They see the potential of the returns because they see fancy numbers, fancy returns. But it's not to say that they know what they're doing. Most new syndicators, I'm going to call them, new people that came from the multifamily world and are coming into the senior living space, they don't understand all this detail. They just think, oh, my numbers look good. I know how to operate it, or I'm going to find a good operator because that operator knows what they're doing. We're at the moment in this industry that money's coming into the space and new businesses, existing businesses are getting bought up. They're exchanging hands. But there's not enough good operators out there. So even the weaker operators are having a chance to operate a community or grow their own portfolio. Most of the time it's third-party operators. You have the owner, the syndication team, and they third-party it out to the operator. But if this operator, his business plan historically has been operating 50-bed communities, but then a syndicator or private equity firm purchases a 100-bed community and they can't find an operator and they're scrambling, and this operator paints a good picture, has a great presentation, shows that they can do the job. This owner might hire this third-party operator. But what was the key point? The key number. This operator historically has operated 50-bed facilities. So now he's jumping to a 100-bed facility. Can he do that? Does he have the internal staff and systems to jump or to double his workload? Does he have the education to do that? So an operator going from 50-bed to a 100-bed facility is a dangerous combination. That is a recipe for disaster. So as an owner, as a syndicator, you have to find third-party operators that have operated what your buy box is. If you're buying a 100-bed facility, find an operator that has the reputation, the ability, and the knowledge to operate a 100-bed facility. There's no sense in just scrambling for the operator, because what did I say before? The operator makes or breaks the business. So most investors don't understand this. They're just rushing to the space, chasing this magical return. So opportunity is an advantage for myself and for leaders and owners that want to succeed and have the knowledge to do so. That's my edge. When you understand revenue drivers, expense control, operational execution, you start seeing opportunities that others miss. It's been historically easy to operate a senior living community in the past. You've had large institutional investors owning and operating at a large scale, and you've had one-offs that are mom and pop shop kind of owned, that their competition is their competition, and both competitions are doing the same thing. So there's no need to compete in a sense. They get move-ins, they increase occupancy, I charge $4,000, they charge $4,000, everyone's happy. But with more money, more investors coming into the space, competition's heating up. So you have to be on top of your game. As an owner, operator, I got to know what my competition is doing and what they're using. So for example, right now, last couple of weeks, I've been talking to AI companies that can track heart rate, body temperature, glucose, movement, sleeping patterns, slip and fall detections. These are all systems or technology that I'm implementing that is not in the industry at all. And when I'm implementing them, it eases up the workload for my staff. It's a system that makes their job easier. I'm giving them the tools, the information, and the resources to make their lives better, to make their 8-hour shift most efficient shift that they can have. And I'm saving money. So if I can eliminate 0.5 of an hour or 0.5 of a staff member because I have the right systems in place, that's driving the NOI. That's saving on payroll. That's saving on expenses. So marketing, technology, educated owners, these are disruptors in the space. And if you have the right owner that understands what's needed to disrupt this industry and to implement the right systems at a base cost while saving money, that's a win-win for ourselves, for the residents, and for you, the investors. Senior living is not real estate. It's a business. So don't get caught up in multifamily senior living as being equal. They're two different investment strategies. Not one's better than the other. They're two different investment strategies. I tell people, would you invest in an HVAC company? Would you invest in a car wash? Would you invest in a dry cleaners? They're all businesses, but people don't think of it as a real estate play. They think of it as a business. The investors that I come across are historically thinking senior living as a real estate play, and they're wrong. It's a business within a four-walled real estate environment. So if you want me to break down a real step-by-step with actual numbers, you comment SLF below. I want you guys to subscribe to my weekly senior living investment education SLAM playbook YouTube channel. Subscribe, like, spread the word, spread it on social media, tell all your friends. I'll see you guys next week on the YouTube SLAM playbook channel. Your host, Roberto Caravetta.